Have you ever wondered how to invest in volatile stocks? Well, you're not alone. Let's start by defining what volatile stocks are. Picture a roller coaster ride with peaks and valleys. That's volatility in a nutshell. Stocks that experience significant price changes in short periods of time. Why are these stocks attractive? For one, the potential for high returns. Think of it as a high-stakes game. The higher the risk, the higher the reward. But it's not all rosy. Investing in volatile stocks is akin to walking on a tightrope. On one hand, you have the prospect of substantial gains. On the other hand, you face the possibility of losing a significant portion, if not all, of your investment. Remember, the stock market is not a casino. It's a platform for investing in businesses. The key is to tread carefully and make informed decisions. So, how does one navigate this high-risk, high-reward landscape? Let's dive into it. But before we continue, if you like this video, please remember to share it with your friends. Hit the like button, subscribe to the channel, and then watch some more of our videos. A key step in investing in volatile stocks is understanding the market. Picture it as a vast ocean, with currents and waves that are constantly changing. Your role as an investor is to navigate these waters, and to do so, you need to study the patterns and understand the rhythm. The stock market is not a random phenomenon. It's a reflection of economic activity and investor sentiment, and it has a history and trends that you can study. For instance, we know that over the long term, the stock market has generally trended upwards, despite periods of downturns and volatility. This is called the primary trend, and it's important to keep in mind when investing in volatile stocks. The secondary trends, or the short-term fluctuations, are where you'll find volatile stocks. These are often driven by a multitude of factors, including economic indicators, corporate earnings reports, and news events. The key is to be able to discern the signal from the noise, to identify the trends that matter. Speaking of news events, let's talk about the role of global events in influencing stock volatility. From geopolitical tensions to natural disasters, global events can have a profound impact on stock markets. They can lead to uncertainty, and uncertainty often leads to volatility. As an investor, it's important to stay informed about these events and understand how they might affect the stocks you're interested in. However, staying informed doesn't just mean keeping up with the news. It also means keeping an eye on developments related to the companies you're invested in. Are they launching a new product? Are they facing a lawsuit? These events can cause a stock's price to swing dramatically. Understanding the market is crucial, but it's just the first step. Next, we need to identify potential investment opportunities. Remember, the ocean of the stock market is vast and full of possibilities, but only those who understand its currents can hope to navigate it successfully. Identifying which volatile stocks to invest in is a critical step. Now, in the vast sea of stocks, how do we pinpoint those volatile ones that could potentially lead us to attractive returns? Well, we start by looking at indicators such as high beta coefficients. A beta coefficient is a measure of a stock's volatility in relation to the overall market. Stocks with high beta coefficients, typically above 1, are considered volatile as they tend to move more dramatically than the market. If the market goes up by 2%, a stock with a beta of 2 might go up by 4%. However, keep in mind it can also swing the other way. The higher the beta, the higher the risk, but also potentially higher the reward. But don't just stop at beta. It's equally important to dive into the company's fundamentals. Just like you wouldn't buy a house without inspecting its foundation, you shouldn't invest in a stock without understanding the company's financial health, its competitive position, and its growth prospects. Look at the company's balance sheet, assess its earnings, and evaluate its management. These fundamentals will give you a clearer picture of the company's potential for long-term success. Finally, and perhaps most importantly, consider your own risk tolerance and investment goals. Investing in volatile stocks isn't for everyone. It requires a strong stomach and a long-term perspective. If you're nearing retirement or can't afford to lose your investment, volatile stocks may not be for you. But if you're young, have a high risk tolerance, and are looking for high growth potential, volatile stocks could be an exciting addition to your portfolio. Identifying potential investments can be challenging, but with thorough research, it's definitely doable. Now, let's talk about managing your investments. Managing your investments in volatile stocks is where the real challenge lies. It's like commanding a ship in stormy seas. You need a strategy, and one of the most effective strategies is setting stop-loss orders. This is like setting a safety net under your investment. If the stock's price drops to a certain level, the stop-loss order kicks in, selling the stock and preventing further loss. It's a way of saying, I'm willing to risk this much, but no more. But the work doesn't stop there. Regularly reviewing and adjusting your investment portfolio is crucial. Picture yourself as a gardener, tending to your financial garden. Some plants might need more attention, some might need less. Some might need to be pruned, while others might need to be uprooted altogether. This is the essence of managing your investments: constant attention and adjustment. And let's not forget about diversification, the financial equivalent of not putting all your eggs in one basket. When you spread your investments across different stocks, sectors, even asset classes, you're essentially spreading the risk. One stock might be doing poorly, but another might be soaring. Diversification helps balance the scales, managing risk and potentially increasing your chances of overall success. Managing your investments effectively can help mitigate some of the risks associated with volatile stocks. But remember, even with the best strategies, investing in volatile stocks is not without risks. So, that's a simple guide on how to invest in volatile stocks. We've walked through understanding the market's ebb and flow, pinpointing volatile stocks that could be ripe for investment, and managing these investments effectively. It's crucial to remember that this is a high-stakes arena. The potential rewards are considerable, but so are the risks. Always do thorough research and only invest what you're willing to lose. Remember, investing in volatile stocks is a high-risk, high-reward game. Always do your research and don't invest more than you can afford to lose. Happy investing! If you liked this video, please share it with your friends. Hit the like button, subscribe to the channel, and watch more of our great videos.